Hi, I'm Jeff Bermet, and along with Nick Davis, we're the co-managers of the Libero Cautious, Dynamic, and Solutions Funds. We are speaking to you today on the 6th of May. We last spoke to you, where we last recorded our update, on the 27th of March. So a great deal has happened since that time. The most important event has been the ceasefire that Iran and the US have agreed to. Admittedly, there have been still some missiles flying back and forth and some drone work and some ships fired at, but broadly, the US has stopped its offensive military operations against Iran. Iran is still not permitting ships to go through the Strait of Hormuz. The US has responded by not allowing Iranian ships to pass through the Strait of Hormuz in an attempt, I think, to choke off any oil revenue that the Iranian government would normally receive. That has, I would say, intensified the discussions between Iran and the US on some sort of peace deal. And as I speak to you now, President Trump had said they're very close to a deal. The markets, since this ceasefire was declared at the end of March, have been soaring upwards. And so everything that declined sharply in March when the war began has reversed and is now, in the case of the US, we're seeing new all-time highs in the equity markets there. And it's being led by big tech, artificial intelligence, CapEx spenders, and then all the companies that benefit from that spending. Those share prices have been doing exceptionally well, in particular, the chip manufacturers. So not just NVIDIA and TSMC, but also Samsung, now Intel, Qualcomm, Infineon, almost anyone that manufactures chips that are required not just for artificial intelligence, but for all the equipment around that, has seen extraordinarily strong share price movements. And thankfully, we're participating in a lot of those movements. And energy stocks have also done well, as oil prices, even with this ceasefire, are hovering around $100 and in some days $120 a barrel. I would say the only areas that are really struggling have been consumer sort of discretionary businesses that are very sensitive to what's happening to gasoline and jet fuel prices and diesel prices. And there is a problem. I mean, for the past 8 weeks now, countries have been able to draw down their inventories of these products, of gasoline, of jet fuel, of diesel, of oil, to replace what has been lost that's not passing through the Strait of Hormuz. At some point, that's going to run out. And the question is, will those stockpiles run out before a more durable peace deal is achieved between the US and Iran that perhaps allows energy prices to return to a level closer to where it was before the war began? I fear that Iran has now learned that it is very, very easy to threaten shipping through the Strait of Hormuz. It's unclear that the world's going to return to the pre-war levels of $60 a barrel oil, with Iran now realizing it has this capability. Fixed income markets have continued to be unsettled by what's happening, despite the fact that central banks have done nothing at the 2 meetings they have had since this war began. We had meetings in mid-March and then meetings just last week by the Fed, by the Bank of England, by the ECB, by the Bank of Japan. They have held off on adjusting rates. They've all observed that this energy shock is unknowable. It's hard to predict where it is going to lead. They have all, at their last meeting, reaffirmed that if they had to, they would raise rates if they felt second-order impacts of the higher energy prices were flowing through the economies and producing more broad, widespread inflationary pressure. So they have threatened to respond, but I think it's very unlikely that they will unless this conflict is clearly behind us. I think they all see the outside risks of, were the conflict to reaccelerate, or there was perhaps more damage in the Gulf and more oil resources were shut down, the oil price could spike significantly higher than it already has. It could spike to a degree that could in fact cause a global slowdown or perhaps even a global recession. And in that case, I think the central banks would feel it would be wrong to hike to fight inflation, and rather they would be looking to ease policy to mitigate the down move in economic activity. But we are ways away from any of that. But the bond markets have been uncomfortable with that threat. They are also uncomfortable with what inflation is doing more broadly. It has begun to climb because of the energy price move. And I think bond markets are also incredibly sensitive to just what's happening on the spending front. You know, the US is talking about spending an additional $500 billion on defense in their fiscal year 2027. Germany is already committed to spending several $100 billion more in defense over the next few years and additional money on infrastructure. So they are already on course to increase their fiscal deficit. Here in the UK, they are scrambling to find ways to continue to fund the generous social welfare programs here and also boost their defense spending. And throughout Europe, there's that challenge of how can countries continue to meet their social obligations and also increase defense spending at the same time. And the only way to do that is to borrow money. Bond markets are unnerved by this, and there just doesn't seem to be any prospect of governments changing that. So we continue to stay away from the longer end of the bond markets. The AI CapEx spending program, it is getting ever larger. The major spenders just announced their CapEx plans for the balance of this year with their earnings statements came out last month, and they are all higher. Microsoft, Amazon, Meta, Alphabet, they're all going to spend more on expanding their AI capacity than they had initially planned for this year. And that was already a large number. And in addition to that, they have all remarked that they can't meet the demand for AI computing power that their customers want. So firms like Anthropic and OpenAI that want to run their and develop their AI models, and countless other firms that are working on artificial intelligence models. And there's also growing evidence that these models are starting to have an impact on businesses. Businesses are benefiting from using them, so we feel that this spend is going to continue, and the beneficiaries of this spend, the chip makers, are going to continue to have very strong earnings in the quarters ahead. How can we as countries make ourselves less reliant on fossil fuels, particularly if we rely on fossil fuels that have to transit through the Persian Gulf? And I think countries are going to look at more wind and solar and alternative energy sources. And I think there's also going to be just a boom in exploration for fossil fuels in other parts of the world that are away from this troubled zone. So we still see a lot of benefit in our mining holdings and in some of the energy infrastructure exposure we've added to the portfolios. In the back of our minds, there is the worry that if the conflict were to suddenly reignite, get much worse, push oil substantially higher, you know, that risk of a world recession is out there. But I think near term, you know, we're already seeing some responses to higher jet fuel prices and gasoline prices on the part of consumers. Airlines are canceling flights, reducing their capacity. People are changing their vacation behavior. It will be interesting to see if consumers in the US choose to drive less, with gasoline now at over $4.50 a gallon. So it is something we're watching, but at present, at these levels of energy prices, the world is not destined to necessarily have a recession. We are now 6 months away from the midterm elections in the US. The Republicans have a very narrow majority of about 5 seats. The Democrats would only have to take a handful of seats to win back the House. There are probably 20 races that are ones that could flip either way to Democrats or Republican. It is clear from the polling going on right now that the Democrats will easily win the majority of those races and take back control of the House. So we'll be looking at a very different US government with a Democratic Congress, and there is even a possibility that the Democrats could take the Senate as well. As long as the ceasefire holds and there is an attempt at progress resuming sea traffic through the Strait of Hormuz, we expect markets are going to continue to respond positively.
So Jeff has talked about the wider market and things that we've seen impacting the portfolios over the last month. Surprisingly, it's been among the chip holdings we've seen our strongest performances. Positions like Infineon, Qualcomm have been driving the portfolio higher, and that have been very helpful performances with very strong double-digit returns. Alphabet and Amazon also have been key in our top 5 performing holdings over this period, alongside our broader position in the Polar Cap Technology Fund. Again, these are all following the same and similar themes in technology, with that exposure towards those kind of very much AI-driven stocks and the chip providers. The one stock that stands out perhaps in our top 5 holdings in terms of performance over this month has been Prysmian, which is a non-tech stock, but is a copper wire manufacturer based in Italy. And again, this is part of our energy and the wider AI theme of data centers, etc. How does this all pan out? There needs to be a form of transmission, and sadly that's through the copper wire. And again, that's why we have our positions in the mining companies, because of that demand for copper we see increasing over time. Again, very strong performance in this position, up about 34% over the past month. Conversely, some of the other very strong performers over the longer term have been the defence companies, and these have been hard hit over the past month. Again, a short-term period. We've been through a strong period of volatility because of the activities in the Gulf, where it's one day it's open, one day it's closed in terms of the Straits of Hormuz. And again, this is reflected in the price of oil, which has bounced between $100 to $126 a barrel. Longer term, we may see a more consistent pricing in terms of oil reaching around $100 a barrel. The one interesting move we saw over the last month was the UAE leaving OPEC. Despite this short-term volatility, we still remain very focused on these positions and the long-term demand for energy and for the defence industry. So we have no concerns over this shorter-term period of a bit of weakness in performance. Jeff also talked about the impact on the central banks, and again, with this higher oil price, we're seeing no real move from central banks to react to that. And again, we think there seems to be a level of comfort around this, that the economies are growing well, and this isn't an issue so far. We await to see how that pans out, and obviously with a change of leadership at the US Federal Reserve later this year, again, that will be an issue that will probably come to the fore. So in short, the portfolios are doing well, and year to date, surprisingly, despite the volatility we're seeing in the world, they are in a positive position, and we're very happy with how we're positioned to carry on for the rest of the year.